Hi, it's Thomas. Welcome back to the course Financial Institutions and Markets. The topic of today's lecture is capital markets, equities. To begin our look at equities, let's compare bonds, which we've previously seen, to equities. Bonds are a form of debt. Bondholders do not have ownership in a corporation. The interest and eventual principal payments to the bondholders are legal obligations of the corporation. They have to make those payments legally. And bonds have priority over equity in firm liquidation. Liquidation means that the company sells all assets, pays off liabilities, and then distributes the residual cash to the owners if there is any cash left. Before those cash payments are made, before any cash is paid to the owners, any lenders, and bonds are a form of debt, so bondholders would be paid off in full, including any interest that hadn't been paid, which we refer to as accrued interest, before the equity holders receive anything. So the bonds are a lower risk form of security than equities. Equity is a form of ownership. The stockholders are the owners of the company. Dividend payments are not legal obligations. So when an investor owns stock in a company, they might want to receive a dividend, and it's possible a company will declare a dividend. A company might not declare a dividend. There's no requirement that a company pay dividends. And in liquidation, the equity holders, the shareholders, are the last in line. Everybody else gets paid before the equity holders get paid. So this is a higher risk security relative to bonds. Now looking at some particular characteristics of equities. As we mentioned, shares represent ownership. Equity holders are the owners of the firm. There is no maturity date for equities. Unlike bonds, which come due at some date in the future, equities don't have any kind of maturity or due date. There's also no legal obligation on the part of the corporation to ever pay anything to shareholders, which might sound a bit surprising, but let's look at that to understand what does that mean. In the case of dividends, as we've mentioned, the companies that are behind equities might pay dividends, they might not. There's no legal obligation for a company to pay a dividend to investors. That's a decision of the board of directors. And additionally, if a company liquidates, and only if, then a shareholder might receive cash proceeds from that liquidation. If there aren't enough funds to pay off the liabilities of the company, then the equity holders actually won't receive anything. But even assuming there are significant funds, there are adequate funds in the company, unless a company liquidates, there is no legal obligation for them to ever pay anything to shareholders. If a shareholder wanted to exit the investment, receive funds from that investment, then they can sell their shares in the secondary market, but they can't make a demand on the corporation itself to buy back those shares or make any form of payment to the investor. Now let's look at equity valuation concepts, and we'll learn two tools we can use to value shares. One is the dividend discount model, and the other is the price-earnings ratio. In valuing equity, there are two components to equity valuation. One is the current cash flow payments that would come from dividends if a company pays dividends, and the other is capital growth. As a company grows and becomes more valuable, the shares typically will increase in value, and if a shareholder were to sell those shares at some time in the future, then the investor would receive a higher per share price at sale than they had paid for the shares at the initial investment. There are numerous factors that drive share prices, but as a general concept, we can look at a company and say that if the company is growing, then the value of the company is increasing, and at the individual share level or share price, there will be an increase in value as well. So now let's look at these two valuation tools. First, the dividend discount model. The dividend discount model is only relevant to companies who pay dividends. Assuming the company is a dividend-paying corporation, then we can use this model, and there are three inputs that we need to calculate price based on the dividend discount model. The required return on investment, which is determined by the investor, the future dividend payment, a dividend 1 year into the future, which is determined by the company, and the dividend growth rate, which is an estimate that is made based on financial analysis of the company's current financial position, its future financial prospects, and there's uncertainty in what that growth rate is. That's an estimate, in other words. If we have those three numbers, the formula is stock price is calculated as the dividend 1 year into the future divided by the difference between the required rate of return on a stock and the growth rate of the dividend. We can abbreviate using the symbols P equals D1 divided by the difference K minus G. Now let's look at a couple of examples. Calculate the stock price of a company with the following characteristics. We're given the dividend 1 year out, the dividend growth rate, and our required return. And applying our formula, we're going to plug in the numbers that we have, the dividend in 1 year divided by the difference between the required return, the dividend growth rate, gives us a stock price of $29.07. Now let's look at the same company, except we'll change the dividend growth rate to 0%. We plug in our numbers, dividend 1 year out, required return, dividend growth rate, this time as a value of 0, and the resulting stock price is $18.96. So what we see in this case is that the value of $18.96 is less than the prior value we calculated of $29.07. That's reasonable. When we have the same dividend and it's going to grow in the future, that's more value than if we're looking at, and notice the result here, about $29 stock price value. That's a better scenario than the same dividend which isn't growing in the future. That's not as valuable. So we expect and arrive at a lower stock price as a result. That's the dividend discount model. We'll take a break here, and when we come back to the second half of the lecture, we'll go into our second valuation model, the price-earnings ratio.